Hello and welcome to the second in a series of short podcasts to help stimulate your minds in support of the forthcoming deadline surrounding Consumer Duty annual assessment. To focus the minds, the deadline is the 31st of July 2024. My name's Lisa Martin and I'm joined today by Martin Sykes, our Compliance Operations Director for LSL Financial Services. And our aim today is to bring to your minds some thought-stimulating activity and to particularly focus on the areas of price and value. Our first podcast very much focused on why the annual assessment was necessary, why it's due, and what the expectations were by the regulator. We talked about this review being fair and proportionate to the size and scale of your business, and we particularly focused on one of the consumer outcomes, which was products and services. So today, Martin, it could be a wee bit more contentious. We're going to talk about price and value. So just bring to life, Martin, perhaps some introduction on price and value and what the expectation might be in this particular area.
Yeah, so again, if we cast our minds back to the Consumer Duty implementation, the rules and the guidance, what FCA were really trying to get at, or are trying to get out with this outcome, is that the price a customer pays for the product or service is reasonable compared to the benefits that they get from it. And I think the reg background is really that FCA have become concerned that firms were creating, marketing and selling products where there was little value for the customer, or the price was very high compared to the value. And you can think of examples, particularly in the GI space, actually, where products were created or add-ons were created where either there was little prospect of the customer ever having an insured event or of getting benefits under the product. So FCA particularly, I think, aiming at removing the possibility of customers buying a product or a service that is manifestly a rip-off. It's that that's the sort of reg intention really of this area of Consumer Duty.
Okay, so just sort of bringing this to life. I mean, we talk about the actual product, and you gave us a bit of an overview on that. But perhaps let's just focus on products. What sort of product areas do you think that the regulator is particularly keen to have a look at?
Yeah, so I think in our market, and as we discussed last time, what we're mainly doing is manufacturing a service, that being advice on mortgages, advice on insurance, and however you break that down. So particularly mortgages, where it might be on sort of different subcategories of mortgages, and then we're distributing somebody else's product that's been subject to a separate fair value assessment. And I think the sort of if you look at mortgages first of all, the way in which our fees, so the cost for our services are brought are through broker fees. Mainly. Now the broker fee market, actually, there's a sort of mixture. A lot of firms still don't charge a broker fee at all. So the modal broker fee in the market is actually nil. and then you sort of build up from that. But very few firms charge very much for prime normal residential work. I think though where the regulator is focused in this market is around the sort of niche products of second charges, regulated bridging, adverse, to some extent equity release, and to some extent debt con. So probably in that order, you'd think of those are the areas where FCA have a view that the price that we're charging in this market might be too high in aggregate, so across the whole of the distribution chain. So I think in terms of this outcome, firms that are active in those markets in particular probably have a bit more work to do around understanding whether they're offering fair value, etc., than do firms who are who are not. So slightly more straightforward assessment, I think, for prime resi stuff.
Mhm. So the sort of starting point of that is probably pulling off your new business register, having a look at the mix of your business, looking at which types of projects and which types of customers, and whether those particular products suit those customers' needs. But then, furthermore, what are the charges and prices and costs around that particular segment of products?
Yeah, certainly. I think we talk really about the fair value assessment in particular and pricing. Sort of particularly along the dimensions of the utility the service adds. So that's really the benefit received by the customer. And we sort of, the TMA conference, I sort of jokingly talked about outside of our world, so something like a GP practice, a doctor's service. I think that's a very high utility service. We can't get it anywhere else. And it's the gateway to other services. It's very important to us, and so that's a high utility service. And then something like I sort of jokingly referenced a service at a hotel where someone sort of walked from behind the counter and pressed the button on the lift for me.
Yeah.
That's a very low utility service because although I quite enjoyed the feeling of it, I could have pressed the button myself. I got to the room in the same speed as I would have done otherwise. It didn't really add a lot of value, and I probably wouldn't be willing to pay very, very much for it. So that's really the first element we should think about in terms of price and value. It's what benefit are we adding to the customer through the service? And for most of the mortgage work that we do, that is quite GP like. So the customer can't get a mortgage in the main without going through an advice process. It's very important to them, and it can save them quite a lot of money if it's done properly. The calculation's a little bit different for purchase and remortgage and PTs, where they can access it actually themselves, and we're adding a bit more value. But you can see how that sort of plays there in that in that particular space. When you get out though into the niche areas, so seconds and those kind of things with long distribution chains where somebody else is doing a lot of the work, then you do sometimes get a little bit into the lift space with those. So we're introducing them or giving them to somebody else who does the bulk of the work. And we can end up in a bit of a mere conduit space. And I think that's part of the concern of FCA is, there's lots of people in the chain. Some are doing lots, some not that much, but they're all adding bits of cost. That's some of the thinking that needs to be done across that bit of the range.
So to be clear on that, that's where you maybe using a packager or referring business on.
Yeah, exactly.
There's more of you in the chain that are adding to the cost because of the service they're delivering as well.
Yeah, and where is the bulk of the value being added to the customer? Is sometimes not our part of the process, but it's at the packager or their part of the process. And then the second dimension that we think about is a cost to serve. So this is how much does it cost us to provide the service, and that's a sort of judgment, key to the judgment about the reasonableness of the ongoing price to the customer. And I think in terms of the annual review, you'd particularly want to think about this in places where you discriminate charges between groups. So if you charge differently for customers who arrive to you by telephone or who you deal with by telephone to ones who you deal with by a face-to-face or a traditional method, then that should really be brought out in the review. We're happy that there should be a difference in the charge between these two groups because of these differences in the cost to serve. And then the third dimension is the sort of, FCA talk about it as, can you get the same product or service for significantly less elsewhere? And so in terms of the report and the sort of thinking around the MI and the monitoring, I think that question therefore is really answered in the report of, are our charges in the round similar to what other people charge in the market for the service that we provide? And none of those three get you over the fair value point on their own, but it's the kind of thinking around the three of them. So I think there's sort of a report that briefly covers those three elements would really help to close off this point in respect of the services.
I mean, it's always quite a contentious one, isn't it? When I suppose the cost of service as well, which is obviously something that's part of the business in terms of a DA firm in this instance is sort of challenged and questioned. And obviously, we're seeing perhaps a move a little bit more now by lenders, in particular, to look at, you know, the parameters of what they feel is expected, or what they feel is fair in terms of what additional fees are charged over and above the fees within their product that they're delivering to the broker. So, you know, we've seen some various parameters come out, and different parameters perhaps does again cause a bit of a nightmare for some of our brokers. But equally, perhaps, what's your thought on these parameters and this sort of view that lenders are talking about? We're quite happy to this level or this level over and above what the standard product is that we've signed up as fair value.
Yeah, I think, you know, lenders have always been interested in the broker fees that are being charged on their products, and you know, for a long time, many years, in some cases, they've done work to flag outliers, and without necessarily being very explicit about, you know, where they're setting their parameters for labeling things as outliers or higher than they expect or want. And from a reg perspective, which I guess is the perspective you'd want me to answer from, you know, it is up to the manufacturers of products to say, you know, what are the parameters of fair value for this product. So if a lender is saying, you know, the maximum fee that we think should be added to this is X, then really from a reg perspective, what they're saying is this product offers fair value until or unless a charge of this amount is added to it once it leaves our factory gate. And that is a relatively solid regulatory position. I think then you get really into the sort of slightly more nuts and bolts question of, you know, are the levels too high, too low, and are we a little bit into, you know, kind of cutting across in any places the three things that I talked about before. So particularly cost to serve point, you know, if we start to duck below the cost to serve, then that, you know, that's a fairly significant impact on the market.
Yeah, and so in cost to serve, you know, there is the differences that you've outlined, you know, in terms of different services, and you know, this isn't just even necessarily in the areas of mortgages. So in terms of protection, and you know, in other areas of business as well that the firms might write, you know, what other things should they be, I suppose, signposting or demonstrating in terms of the service? What other things that they do does have an absolute value, but they may forget in terms of it's just built into their business processes and what they do?
Yeah, and I think understanding the service costs as a whole are important, aren't they? So I think there's, I mean, it's quite interesting in the macro data around fees. You know, from the market, it suggests that fees are getting lower, not higher, actually, in mortgage world. And yet, the work that we're doing in respect of mortgages is getting higher, not lower. So particularly the, you know, the long leads on product transfers, you know, all the work that's been going into those, but that isn't falling through into increased broker fees, certainly not in the data. But in terms of you know, understanding your fair value position, those are really important. So how many hours are spent between the customer arriving with you and you finishing with them in their deal? You know, that's the number that you need to think about, plus anything that you would reasonably expect to do in between. So you know, if the customers, you know, there is a tail of service beyond completion of the deal, then that as well, you know, forms part of that equation.
Okay.
And I think it's, you know, it's you know, it's worth saying really that, you know, this area of the annual report, the fair value point, I think for most firms should be quite simple.
Mm-hmm.
You know, I think there's very little sign of mortgage broker fees being, you know, high in inverted commas. You know, most of them are clustered around relatively low numbers outside of the sort of niches that we've talked about. And so I think, you know, I don't think a need for really complicated work here.
Yeah.
It is focus heavily on those niche markets if you're in them. Think really critically about them, because those are where the reg intervention will occur. The rest of it should really write itself up. You know, those standard broker fees are fine. You know, they're fine. And I think you can see how they would be fine against the, you know, the three things that I've sort of mentioned earlier as the assessment criteria.
Okay. Just in terms of anything else linked onto this, what is there any other areas that, you know, the brokers should be considering in their assessment in terms of this particular area of price and value? Anything else that comes in at all?
Yeah, so I think you know, when I'm out and about, the sort of questions I get asked a little bit are, you know, we don't charge a broker fee. So what do I do here? Well, on the service point, I think the report should say that, you know, we don't charge a broker fee. So, you know, our service is based on the population fee, which has been assessed by the lender on the way out as part of their value fair value assessment. I think in the world of protection, the argument is the same. So the products have been fair value assessed by the provider, and they leave the factory gate, if you like, in a fair value state. So as long as we're not adding cost to it, then the distribution's fair value. In both of those areas, though, that is contingent upon us distributing it to the target market and via the distribution strategies that are detailed in the providers and the lenders materials. And as we spoke around last time, but most of those are very broad. So they are distribution by any route to a customer who wants life insurance. You know, it's what you see, but not always. So again, it's like picking out those products that have got a different distribution strategy or different target market, making sure those have been distributed that way, as we talked around last time, is important. But again, I think in terms of the report, therefore, the protection, the GI, where we're not adding fees, should just recognise that we're not adding fees and that we are confident we've distributed it in accordance with the strategy, the distribution strategy in the target market that the provider or the lender has specified.
Okay. And having evidence of that, should you need it, I suppose, and having that old document is you know, in essence what this review sort of points to, really, in that bit of an audit on your own homework, really, isn't it?
Yeah, and I think, you know, MI here is more difficult, really, than in some of the other areas. You know, as I said, a little bit of assessment around what we charge versus the market is probably a key piece of MI. Complaints, information around price of customers who say, you've charged me too much, or those kind of things would play here. But most firms won't have enough data there, you know, because of the numbers weren't high enough. For very big firms who do, you know, then it's worth looking for that piece of data. I think any data around customer questionnaires, so that, you know, the information that's come back from them around even the generic things like net promoter score or the positivity elements would, you know, suggest that customers are feeling that the product was good value, and perhaps a little bit as well around the process. So our level of satisfaction that we have disclosed the fees properly to the customer on the way out will probably be the other one that I'd pick up. So if advisors are, you know, being tested, you know, do they know that's part of the process? And you know, are you confident that piece of disclosure is occurring properly? So those are the pieces of MI that I think I'd try and draw out in the small to medium firm world.
Okay. And of course, the regulator, this is, you know, across the whole industry that we're looking at here. So, you know, there are some complexities in the IFA businesses, more so, perhaps in terms of some of these elements we've discussed today, but we are talking about mortgage protection
absolutely. And if you were a big product provider, and this area here would be very significant, and extremely complicated. But we're not. We're in the main simple businesses with relatively few services with relatively simple price, and our annual report should be proportionate and reflective of that.
Okay, that's been really helpful, Martin. Is there anything you wanted to add finally on this part of our consumer duty assessment for the deadline once again, 31st of July?
No, I think that the one thing I'd leave firms with, and I may have mentioned it through the course of it, is the focus is on those niche areas. So seconds, bridges, adverse, debt con, and equity release. Those are where the charges are high. Those are where the distribution strategies are long, and those where the areas where FCA are definitely interested. They were interested before consumer duty, and they're even more interested now. And so that area is, if you do one thing, that is the thing that I do in this area, is think about the charging structures there.
That's the key takeaway.
Yeah, it is from me. Yeah. Thank
you very much. So we'll wrap up on today's version, podcast number 2. If there is any feedback in terms of any further questions, we will address these in a later podcast, gathering any information, feedback, or particular questions that you have. But for today, thank you, Martin, and we'll see you in the next series of the Consumer Duty Annual Assessment. Thank you.
Thanks.